Welcome back to our channel. Today, we have a fascinating topic to discuss. What do banks do with your money? Have you ever wondered what happens to your hard-earned cash once you deposit it into a bank? Well, you're in the right place. In this video, we'll take a deep dive into the world of banking and explore what exactly happens to your money behind those bank vault doors. So, let's get started. To understand what banks do with your money, we need to grasp the fundamental concept of banking called fractional reserve banking. In a nutshell, banks keep only a fraction of the deposits they receive and use the rest to generate profits. Let me explain how this works. When you deposit your money into a bank, it becomes part of their reserves. Banks are required by regulations to maintain a certain percentage of these reserves as a safety net, known as the reserve requirement. This requirement varies depending on the country and the type of deposits. The reserves are kept either in physical cash or as deposits with the central bank. The remaining portion of your deposit is where things get interesting. Banks use this money to lend to other customers, invest in various financial instruments, and generate profits. Let's break it down into a few key areas: loans, investments, and operational expenses. First, loans. Banks provide loans to individuals, businesses, and even governments. They carefully evaluate creditworthiness, interest rates, and loan terms. By lending money, banks earn interest from borrowers, which contributes to their profits. It's important to note that banks have the power to create new money through this lending process, known as credit creation. Next, investments. Banks invest your money in various ways, such as purchasing government bonds, corporate bonds, stocks, and other financial instruments. These investments provide additional income to the bank, either through interest payments or capital gains. Lastly, operational expenses. Banks have their own costs to cover, such as employee salaries, infrastructure maintenance, technology upgrades, and marketing. They use a portion of the money you deposit to manage their day-to-day operations. Now that we understand how banks make money using your deposits, let's address an important question. What happens if everyone tries to withdraw their money at once? This scenario is known as a bank run, and it's a concern for both customers and banks. Since banks keep only a fraction of deposits as reserves, they may not have enough physical cash to fulfill every withdrawal request. To prevent such situations, banks rely on liquidity management strategies, such as borrowing from other banks, using central bank facilities, or selling some of their investments. It's also worth mentioning that most countries have deposit insurance schemes to protect customers' deposits. These schemes provide a safety net, ensuring that even if a bank fails, customers will receive their insured deposits up to a certain amount. In summary, banks utilize your money in a variety of ways to generate profits. They lend it to individuals and businesses, invest in financial instruments, and cover their operational expenses. However, it's important to remember that banking is regulated to ensure stability and protect customers' interests. That wraps up today's video on what banks do with your money. We hope you found this information insightful and gained a better understanding of how banks operate. If you have any more questions or video suggestions, feel free to leave them in the comments below. Don't forget to hit that like button and subscribe to our channel for more informative content. Thanks for watching, and see you next time.